Hello everybody, welcome back to the channel. Today I'm doing a video about some of the biggest mistakes traders make about selling covered calls and how to avoid them. Obviously this is a good video to watch if you're a dividend holder and you like selling covered calls now, know how to avoid some of these main issues. Table of contents here. First I'm going to be going over what a call option is. I'm going to fly through that pretty quickly. If you're not familiar with the options, go ahead and check this link in the video above, and that goes over the basics of selling options. Then we're going to talk about naked calls, and no, not the good type of naked. And then we're going to talk about how traders choose the wrong strike and expiration. I mean, it's easy to fall into choosing those wrong ones, and since they're the only two options you have when making a covered call, like, it's important to get those right. And then talk about management. You don't want to be making a trade that you don't know how to manage yourself, so it's important to know the options available to you if the trade goes against you or you change your mind on the trade. So first off, what is a covered call? And a covered call is a contract that is a promise to sell 100 shares that you own at a strike price that you choose any time before the contract expires. And what happens is the buyer can choose to exercise that contract to force you to sell those shares at that price at any time, even if it's out of the money, although that'd be very rare because they'd be giving up money themselves. So in that case, you just say thank you. So the P&L of this is what the graph looks like. Your max gain is capped out at the strike price, because after that you're forced to sell at that price. It lowers your break-even point further down. So if you had the shares themselves without the covered call, your break-even point might be like right here, but because you sold the covered call, you collected money, so the break-even point actually moves over, so that's pretty nice. And the reason why this is continuing to go down here is because you still own 100 shares, even if this call expires worthless. So you still get that one-to-one loss on the shares, although the contract with the covered call would have been at max profit altogether. So anyway, no matter what happens, you keep the premium that you received when you sold this call. No matter what happens, that money is yours. You can go buy lunch, you can go buy a steak dinner, whatever you want. One of the big things to know about the covered call option is that you're giving up potential or upside potential. That's your opportunity cost, and that's why you're getting paid a premium for selling this. And what that means basically is if the stock continues going up past that point, instead of this line going up and you making more money, you're capped out because you're forced to sell your calls, or you're forced to sell your shares. So the primary reason to sell a covered call is to make income on shares that you are holding onto, or to get out of the shares. So if you want to get rid of the shares, you might sell an in-the-money covered call. So you collect a little premium, get a little extra money to exit that position. But right now, we're just going to talk about selling covered calls in the hopes that you keep the shares. Now, some rules that I do when selling covered calls is I got to make sure that I'm 100% okay with selling the shares at the strike price I'm choosing. There's always a possibility that I'm wrong, the stock price is going to shoot up, and I don't want to be like second guessing myself, should I have sold that call or not. Be happy with the profit that you would make if you sell it at that strike. And don't lie to yourself, because that's really easy to do. Something else people don't think about would be this tax implication. I actually got burnt on this once. I wouldn't say burnt, but hit a little bit. I had some shares of AT&T that I was selling covered calls on, and then 1 month they got the covered call got became in the money and got exercised. The shares got pulled away. Now, had I rolled that call option or not sold that call to begin with, after 1 more month, those shares would have been long-term holds. So selling the shares would have been long-term capital gains tax instead of a capital gains tax. So something to think about is if you have a position that is nearing that 1 year mark where it becomes long-term gains, maybe don't sell the covered call or be ready to roll it early so that you don't get them called away. And another thing to think about is, you should keep that premium that you receive for selling that covered call handy, because later the strike price or the price of the stock might move up towards that strike price, but due to theta, you might be able to close that for a small profit. So you might be able to sell this option for $100 and then buy back for 80. You still make $20, but now your shares are uncapped and you can participate in the upside. So just keep some money handy so that you can buy back the contract to close it. And if it sounds like free money, that's because if you're okay with actually selling the shares, it pretty much is. I mean, there's obviously some risks, but those are easily avoidable. Naked calls. I like to say options are like a chainsaw. They're a tool that, when used responsibly, can help you get work done, but screw around a little too much and you get yourself at your knees and send yourself back a couple months. So naked calls is when you sell a call option but do not have the shares to cover the position. And recently I've been seeing a lot of YouTubers talk about selling cover calls because we're on a crash, it's going to crash again, SPY's going down, market's going down, sell those naked calls and make this free money. No, don't, okay? So, yeah, selling naked calls is tempting premium, but you have unlimited loss to the upside. And theoretically, you can wipe your account with just one of these positions, and that's just not being responsible. So, I personally do not do naked calls. You can watch my weekly trading videos, and you won't see a single naked call in there. Every position I put in is a covered call when I'm dealing with the call side. And that's because I think that we need to be responsible and manage the risk that we're taking on. If you sold covered calls on GME at $10 back in November of 2019 or of 2020, in 2021, GME shot up to 450 at one point, I think. That's pretty big losses there. So, like, you never know what's going to happen. Just limit your max losses, and there's plenty of ways to do that. And one of those ways for selling calls is to own the shares that we're talking about here is the covered call. You saw this little P&L here. And another way to limit your max loss when selling calls, if you don't own the shares, is to buy a further out of the money call to create a spread. I think I did a video about credit spreads before, but I'll probably do another one that has better information. And basically what that does is it limits your max loss. So if this was the naked call, if you buy a call out here, then this line will become flat at that point. So you still take a loss, but now it's limited even if it goes to the moon. So don't do naked calls, buy that protection. Just think of it as like a business transaction, buy insurance, like buy that extra call out of the money if you don't own the shares and you don't want to buy the shares to sell a call. And another thing that I like to do is I like to buy an in-the-money call further out in time, like a leap. And I use these when I make poor man cover calls, which have been very good to me. I hope to find some more positions to actually set those up. I'll put a link to a video that describes what a poor man's cover call is. I think it's a good introductory video that'll help you learn what it is and see if it should be added to your tool set, because it is a money maker. Number 3, wrong expiration / strike price. And getting either one of these wrong can really hurt you, and it's just easy to avoid that. Just, you gotta look at a chart. So, the strike price is the price that you would sell your shares at. Basically, just make sure that you're okay with selling your shares at that price. I mean, that's not too hard to figure out. Number 2 is expiration, is the date when the contract becomes worthless and the buyer can no longer exercise the contract to force you to sell the shares. For the strike price, it's important, but one thing I would say, if you want to keep the shares, don't sell too close to the money unless you're truly fine with getting rid of the shares. Don't get tempted by premium. The closer to the money you get, the higher that premium looks, the better it looks, and it's very tempting if you get greedy. But the further away you get from the money, the less money you get, but the less likelihood that you are to get your shares called away. So it really depends on how much you want to keep those shares. Me personally, I like a no assignment strategy. So if I have shares, I tend to like to get them called away. So I'll play close to the sun because I'm fine with maxing my upside potential. But if you've been holding these shares for years and you're a dividend investor, you might not want to let these go. Maybe you want to sell calls at 5% probability in the money, and you're collecting a smaller premium because of that. And I kind of already talked about that, is use probability that out of the money to look at the chart and figure out where the stock will not go. So something to think about, if you're selling these call contracts for just a 0.5% return a month, so if you're doing monthlies, that adds up to an extra 6% return for that position over the course of a year. Like, it adds up. 6% is not something to like laugh about. It's pretty good. An example of this might be like AT&T. You're tying up $2,700 to tie up 100 shares. If you sell a covered call at, say, the 30 strike, you collect, like 17 cents? You only need like 13 cents for it to get a 0.5% return in a month. So even AT&T, you can go and make a 6% return on by selling pretty far out of the money, because $2 on AT&T is pretty huge, because AT&T trades in a small range. Choosing the wrong expiration. And you might be asking, how can you possibly choose the wrong expiration? And that's easy. You're not looking at an event calendar. So earnings, if earnings is coming up, earnings is a crapshoot. You don't know if the stock's going to shoot down or shoot to the moon, but it has to be a catalyst where the price will fluctuate. You don't want to be capping your gains during an earnings event and have your shares called away because you played earnings. Dividend. Some people will exercise call options early to get the 100 shares on the day before the ex-dividend date so that they collect the dividend. And if they're getting that dividend, that means you're not getting the dividend. So be careful about when you're selling around a dividend event. It's okay to skip a month if you don't want to worry about that. Or if you get close to in the money where the dividend is more than the extrinsic value left in the option, you might want to roll out the contract to put more extrinsic value into the contract to deter someone from exercising it early. And then other catalysts, if you follow a company closely, maybe you know there's a conference coming up or a news event, you don't want to be selling on something that has the potential to make the stock go up. Number 4, management. I always say this when I talk to people, never make a trade without a trading plan and knowing how to manage that trade. You have to think about the different things that can go wrong. So 3 things to think about. Trading plan. Take a moment, write down a trading plan. It helps get it on paper. When you have to make decisions and you're looking back, you'll be like, oh, I already thought about this. Here's my plan. Now, whereas others said you must stick to that trading plan, I say you have more information now, so it's okay to rewrite the plan as you move forward because you have more information to make a better decision. But having that initial trading plan will help you get in the right mindset. Think about the worst case scenarios. Just assume you're wrong. You're going to be wrong when you make plays. It's going to happen to everyone. It's happened to me. I'm not going to lie about that. Just assume you're wrong so you can have a plan for what to do if you are wrong. And then know how to manage it. There's plenty of ways to manage options. Make sure you know it. So a trading plan. And prior to executing any trading plan or any trade, come up with a plan. Consider all the contingencies. What's going to happen if it moves against you? What is your profit target? If this call is at 50% profit, are you going to close it to uncap your gain and maybe sell a new call, a covered call a month out? That might be your strategy. A rolling strategy. If your call gets challenged or becomes in the money, are you going to be okay selling the stock, or are you going to try to roll the contract out in time to avoid selling the shares and hope that the stock price goes down a little bit so that you no longer become in the money? Are you okay with risking the upside movement? It's easy to say, well, I don't think it'll ever get to X amount of dollars, and then you see X plus Y happen, and now you're sitting there thinking, I should have never sold this covered call. And like, are you okay with risking that upside potential? So if you plan on a volatile stock, maybe not. If you plan on something like AT&T that doesn't move that much, yeah, I'll risk the upside potential on that one. Assume the worst, and that way you can be pleasantly surprised when the worst case doesn't happen. Thinking of contingencies, what I like to do when I'm thinking about a trade is I try to think about what would happen if my contract gets breached or it becomes near the money. Is my plan going to be to let the shares get called away? Am I going to start thinking about rolling the position? What happens if the price of the stock continues going up and now I'm missing opportunity because I think it's going to continue to moon? Some options here, I can buy to close my contract, or I can roll it out further in time, or roll it out further in time and up in strike price so I can catch up a little bit more profit, but I'm still holding those shares and risk the downside. So think about what are you going to do if it continues to moon and your trading theory becomes, or your trade idea becomes, it's going to continue to moon. Think about what happens if the shares you're holding are starting to lose value. Obviously, the call strike, or the cover call that you have now, is probably like near 90% profit, but you're losing money because the shares are going down. Are you still okay holding those shares? Are you going to sell another covered call after closing your current one closer to the money? Would you be okay selling the stock at that new price? And then think about worst case scenario. What if your stock is really heading down to zero? How are you going to manage that? And I joke CPP because if you know me, I'm kind of stuck in some Baba plays right now. So just kind of think about all these different things, help you prepare to make your trade successful. Management, I kind of talked about this already. Do you know how to close the actual trade without letting it expire? Which is simple, but you have to know to buy to close the position in order to close the obligation to sell those shares. And you can do that at any time you want before expiration. And typically I'll close all my positions like the day or two before expiration, typically, just so I don't have pin risk and that kind of stuff, but that's for another video. If you don't know how to roll, learn how to roll before you start doing options. Once you achieve that level of knowledge and confidence, it's going to make playing options so much easier for you. The simple version of it is that when you go to roll, you buy to close the current short contract that you sold. You go further out in time, where there's more time value in the contract, and you sell it again. And ideally, because it's further out in time, you're going to receive more premium than what you had to pay to close your current contract. And it's just the way the math works out. Sometimes you can even get lucky and move up or down a strike in your favor as well when you're rolling out a contract. But please learn how to roll before you start playing with options. No, are you truly okay with letting the shares go? I think I made that point very clear during this video. How would you get rid of the shares if you decide you need to get rid of them? Well, if you sell your shares and you still have this call contract on, you now have a naked call contract because you got rid of the shares. Don't put yourself in that situation. If you decide to sell those shares after you've opened up this contract, buy to close contract first, and then sell the shares. That way you never want to be in a naked position, or at least I never want to be. If it fits your risk tolerance, then go ahead, but you would not see me in a naked position. I don't care if it cost me more money than I received to enter the position to get out of a naked situation. And then, what would you do if you think the stock would continue to moon past your call? I kind of mentioned that last time. Maybe you just accept that you had max profit for this trade idea and be done with it, let your shares get called away. Or you try to attack it and roll out and up, or just close and eat a loss on the option contract and hope the stock continues to go up to make up that loss difference. A lot of options there, but know how you want to trade it. How would you feel comfortable doing it? And I think that covers a lot in this video. If you have any questions, go ahead and leave a comment. I love responding to those. We do have a free options Discord where people are trying to help each other learn. Please check that Discord out and join it. That's a free Discord. We don't plan on ever monetizing it right now. So just join it, have fun. Every Thursday night, we actually have a Thursday night chit chat where all the traders get in together that want to, and they can talk about their positions and how to manage them and that kind of stuff. It's pretty cool. Yeah, so I think that wraps this up. If you like this content, please like, subscribe, turn on the alerts, and let others know, because I do this to share that information with y'all. Have a good weekend, guys, and good luck next week.
If you're liking this content, go ahead and click like, subscribe, and turn on notifications so you stay up to date on any videos I put out.